today's session is on personal finance. To be honest, couple of months back, when they said I did not know what is the background of these sessions, I prepared something which was completely into trade finance and supply chain finance. I got a feedback saying only 1% of our teams will be interested in this kind of thing because I never knew that it's all general topics that are shared every month. I wasn't aware of that. So what do you understand of personal finance? There are three main concepts to that. So, savings, investments, and protection are the three main pillars, as you can call it, or concepts that are part of your personal finance. But this order can also be a little different depending on the stage or the life stage you are in. Then protection can come second and investments can go to third. That I will discuss when we are going further into the PPT. So what is savings? So for arriving at savings, we need to know what are our expenses. The expenses can be two things. What are our immediate needs and what are our wants? See, what is a want for someone can still be a need for another person. So it is very, very personal. And that's why this is personal finance. The globally standardized ratio is you spend 50% of your income on needs, 30% on your wants. A standard ratio, which many of them say is this. But I have another slide which actually shows you this needs, wants, how things will change because we have different classes of people in the society. We all come from different backgrounds. So there can be some people who just spend 20% of their income on needs because whatever you eat and I eat, a plate of rice remains the same, right? So that varies, and we can see that at the end of this savings part of the presentation. So if someone is able to manage, then they are somewhat average. So everybody does it. We are also doing. We are not performing bad. So needs 50% of the incomes for all primary needs. These needs include food, clothing, and shelter. Make sure the primary needs do not exceed 50%. That's how the general thing is, but you never know. Today, the rents in big cities, Chennai might be a little cheaper than Bangalore, but rent itself takes a large portion of our income. So we just cannot stick to that 50%. So that's why I can show you another ratio, how it can be different buckets. Then wants, the next 30% we can allocate for our wants. For example, buying things that we want, phones, vehicles, white goods. As I said, a TV could be a want 5 years or 7 years back. Today, almost every household is having three, four television sets because nobody wants to give the remote to another family member. Each one wants to have a control on what they watch. So that being the case, for television from want becomes a need. Similarly, vehicle. If I do not have a public transport, I am staying in a place where there are no trains, there are no buses, or I am unable to reach my factory at 6 o'clock if I'm in the morning shift, then I need to have a vehicle to earn that income. Then that vehicle becomes a need and not a want. So your EMI or installment that you pay for the vehicle will actually get into the needs bucket. So that's why the wants and needs changes according to circumstances. And the last portion is the savings. So what is left out of your income after your needs and wants is what you have for savings. Savings does not mean investments. You should very clearly note. So savings is what you earned, what you spent, whatever is left. That is the saving amount. You can put it in your piggy bank, you can keep it in your pocket, you can keep it in your money purse. All that is savings. Now, how you multiply the money from that, that becomes investment. So prior to going to investment, you can see the difference. This is based on my own life experience. I've put in this. For example, if you are a first generation person who has come to Chennai, Bangalore, or any other big cities from a rural area, typically you balance it out like 65% of your income towards needs and 25% because it is very, very difficult to live without certain luxuries today. Because at the end of the day, we are all humans. Our mind will always look at what my friend, neighbor is having. I need to spend on that. It is very difficult to control, but if you're able to control, it's good. So you end up spending 90% of your income. You save 10%. That's a very good start. The standard ratio that we have is all second generation. Probably our parents came to these cities, they were earning, they were working in factories, they were working in offices. We studied here. So we have a little bit of a head start. So we belong to that. And the third generation is mostly, they're probably a little well off. They are not dependent on the salaries for their living because they have enough assets and other sources of income. They are coming to work for passion or for any other purpose. They will spend very little on needs and they can save more, or they can spend everything on their wants as well. You never know. At the end of the day, it is individual. So this is where we fall in. We need to satisfy ourselves. We need to look at this bucket and we need to satisfy ourselves. I can't compare with someone else. So you have to see, okay, I believe I belong to the first bucket. So if I'm saving 10%, that means I'm doing well. I progressively improve on it. That should be the target. Then what is investment? So investment is something that creates income or additional assets for you. Wherever you invest in financial instruments, real estate, and other things as well. So all these things will become investments. So if you keep your money in savings account, then it is savings. You transfer that money into fixed deposit, then that's an investment. But does fixed deposits give you good returns compared with inflation? Most of the times in India, the FDs don't beat inflation. They are either equal or just below inflation. So that is why the first point was Balaji is more experienced than me. He knows everything in life. So he says how to beat inflation. So keeping it in FD, we might not beat the inflation, but it all depends because any growing economy will have a good amount of inflation. But the more you go to other assets, there are a lot of risks as well. We will see those items now. So creating income. So creating income means a meager one. So it is not lying idle. You have invested somewhere, it will give you a return probably equal to the inflation or just above or below inflation. So I put in savings account here is because some savings account gives interest, but today that interest has become dismal. It's about 2.5% if you're in nationalized banks. So savings account needs to be removed from this slide, actually speaking. The recurring and fixed deposit. People understand the difference between a recurring deposit and fixed deposit. When to go for a recurring deposit, when to go for a fixed deposit. Do you have an idea?
Yeah, if we have a bulk lump sum, then we can go for a fixed. If we don't have a lump sum, then we can go for a monthly investment using
So
RD return.
that is the golden rule. If you have a lump sum amount which you don't require for your needs and you don't require for your wants in the short term. Short term can be anywhere between 6 months to 2 years. So if you don't need that money for your wants as well, then you can go in for a fixed deposit. But let's say your income has increased, you got a good rating, you got a good increment. So you started getting a little bit more money, but your needs and wants remains the same. That means from 10%, now you are able to save 12%. So that 2% you can put it into recurring. Every month you can open a recurring deposit account, and you're all in the IT company, so you know all these things can be done online. So you can open a recurring deposit account and put in that 2% because you never know whether your wants will increase at a later point in time. So it all depends. So that is where. So recurring is when you're able to save more month on month from your salaries, then you go for recurring. But if you have a fixed lump sum amount, you go with a fixed deposit. But both of these, as I said, will be equal to your inflation or probably less most of the times. Then comes debentures, bonds, and endowment plans. What is an endowment plan? We'll come to debentures and bonds a little later because endowment plan, what do you understand about this?
Insurance kind of thing, that the returns from insurance, LIC.
Yeah. See, endowment plan is a type of insurance policy where you pay the premiums periodically, and if something happens to you, then the survivor would get, your nominee would get the insured amount. Otherwise, you get back the amount that you paid along with some amount of returns. Historically, if you've seen, endowment plans have not given you returns more than 5%. But when they come with an Excel sheet or when they come with a printed brochure, they show 12%, 14%, and all that. Always endowment plans returns will be lesser than your fixed deposit rates. So insurance is a separate topic that is part of the protection that we have in our investments. We'll discuss in detail, but endowment plan is also one of the ways of creating income, but that income will always be below inflation. But only thing is, I don't know whether we want to call that lucky or unlucky. Let's say I take a plan today for 5 lakhs, but now there are a lot of riders to it, assuming it's a very plain, straightforward plan. I take a plan for 5 lakh rupees. I pay the first premium, could be about, let's say, 20,000 rupees or whatever. And the next day morning, I'm not there. When I'm not there, I'm not there. I'm dead. So my family gets 5 lakhs. So your 20,000, you get 5 lakh return. That's odd. But if you survive, let's say for 5 years, but after that, the returns will start going down. So the risk for the first 3 years or 5 years, the return is very high for your family member. But on the long run, if you survive for 20 years, 25 years during the policy tenure, then that return is very dismal. You can see a lot of charts showing that. So endowment plans are best avoided. That's my suggestion, not an this thing to you. But if you feel you want to go ahead, you can go ahead. But you know that your returns will be less than inflation because we are all becoming an informed investor. That's all. We are not becoming a intelligent investor or a successful investor. Debentures and bonds. So debentures and bonds are kind of loans that you are giving to companies. Bonds are usually for large governmental organizations. Many people might have seen Power Finance Corporation coming out with bonds, which will have a very long period of 10 years, 15 years. These are a little risky, but what I see and why I included this is I see a lot of advertisements coming on YouTube and other online channels saying you can earn more, invest in bonds. Without understanding, getting into these are very, very risky. A few years back, around 2019, there was AT1 bonds, alternate tier one bonds, but that are not issued by companies, only by financial institutions and banks, was completely written off in S Bank. There were so many retirement people who had invested in that they completely lost. So bonds have some amount of security. AT1 and all does not have any security. That's why you get a little bit more interest. Just because you're getting 1 or 2% more than fixed deposit, getting into debentures and bonds is very, very risky. Chances of you losing your capital are also high compared to fixed deposit because fixed deposit you do it at a bank, whereas debentures and bonds you are buying of a company or a governmental institution. So they might say you are getting 10% interest, FD is 8.5, but that 1.5% more comes with a very big risk. Then comes provident fund. Whether we like it or not, company takes 12% and it also contributes additional 12%. So even if you don't do anything, if you are in a corporate job, then you automatically fall into this first bucket because 24% of your income is already getting saved even without your knowledge. You might see it in your salary slips. I don't know how many of you have the habit of looking at your salary slips. So 12% of your basic salary is contributed by the company, and another 12% of your basic salary is deducted from your salary, and both is contributed by the company into the PF. And PF is a mandatory thing. So we save, and if you notice, the interest rates of PF more or less will be equal to the prevailing inflation rates. And since it is tax-free and it is long-term, that's a very good source to create your corpus because we need to create corpus. The first few things, you will not create a corpus because fixed deposits are max 5 years. The bonds, debentures are all 7, 10 years, but you will keep it because you want to buy a car, you want to buy a house. At that time, you use those kind of things. Then the other one, the last one is PPF, SSY, and NPS. I've just put in the short forms. Do you know that there's something called a public provident fund?
Yes.
So public provident fund is very similar to provident fund, but only thing is you take the onus. You will have to open an account with a bank. Earlier it was only with SBI. Then they gave it to all nationalized banks. Now all commercial banks also have PPF. So in PPF, whatever amount you deposit, it does not lie with the bank. The bank is only acting as an agent. They will transfer the funds to the Treasury, the Reserve Bank of India. And whatever amount is there in a provident fund, public provident fund, everything is used for the development of the nation. Whether it's the development of the nation or not, each one will have their own view, especially Chennaites will have your own view. Similarly is SSY, Sukanya Samriddhi Yojana. How many of you have heard about it? Some of the younger girls, they should be knowing it more because their parents would have done it for them.
Actually, it is very good for girl children. Up to 21
It
years
is
of
Yes.
only
age, they get.
applicable for girl child. If you have a boy, of course, you can't open an SSY. So if you have a girl child, and if she is below 10 years old, you can open. But when this scheme came in, most of us who were informed investors, we all opened in the name of our daughters. So where, as a parent, you will be able to contribute and you can withdraw the funds for the higher education of your daughter, any medical emergencies, or at the time of the daughter's wedding. And Sukanya Samriddhi Yojana usually gets a little bit more interest compared to public provident fund. So now you can say there is a gender bias, but you should know this SSY was brought in more to empower women so that girls study, they come to work and all that. So that's why the interest rate is slightly higher in SSY compared to PPF. And it is a completely safe product because again, it is backed by the government. And next comes NPS. NPS is a very big topic. We should cover it separately. So NPS has two portions. As a individual, we can open an account and contribute towards that. As an employer, they can open an account, so that becomes an extended provident fund. But NPS has more avenues because provident fund means it again goes to treasury. Whereas in NPS, it does not go to RBI. There are about 11 or 12 fund managers, all big institutions like ICICI, HDFC, Kotak, then Nippon. So many of these companies, they act as asset managers. So they manage the funds. So as a individual, you have the choice to choose. with whom your funds should go. As soon as you contribute into NPS, you can actually have stating that Arun Charles might have chosen HDFC. Someone else might have chosen Franklin. Let's say Balaji has chosen Kotak. But on first of the month, all of us are contributing. Arun Charles' portion will go to HDFC. Balaji's portion of the funds will go to Kotak, and Kotak fund manager will invest according to the asset ratio that you define. If you don't define, there is a standard ratio as well. As I said, NPS is a very big subject. We should do a session separately for that. So if you are an aggressive investor, let's say like Arun Charles, you're young, you can take a lot of risk. He'll say, I want 75% of my contribution to go into equity market. Balaji, being slightly senior, who has experienced everything in life, he says, I'm happy with my capital. I need to get a return which is more than inflation. Then he will say 65% of my contribution should go to debt or government securities, and only 35% should go to market. You can say that there is an option where you can say 0% of your contribution should go into market. So everything is in your control. If you say, I don't know any of this, I'm not an informed investor, but I only know I need to invest in NPS, then according to the age, there is a ratio in which it keeps varying. As you grow older, your equity portion comes down and your debt portion goes up so that your capital gets protected more and more. So the more in debt, that means your returns will be lesser. The more in equity, your returns will be more, but the risk is also higher. You might lose your capital as well. So that's what is about NPS. We can take a separate session. If you have some quick questions, we can discuss on NPS. Otherwise, we'll go to the other products as well.
Yeah, and one more thing to add is like during maturity, PPF and SSY does not have tax. Yeah, and for NPS, if we are working, I mean, if we opt for old regime, then additional 50,000 will be we can claim.
Yeah, but I don't think anyone is in old regime anymore.
Yeah. Now everyone would have been moved to new regime.
Yeah, my suggestion. As an individual, you just open an account and you can keep it. Only one investment per year is mandatory to keep your account active. Every individual, how you have your bank account, it is better to open. Whenever a company registers, they don't open an account. They register with NPS and they take that onus to deduct from your salary and contribute. PF, company also makes a contribution, they deduct from your salary. NPS, it is deducted from your salary and remitted into NPS. When they deduct from your salary, that portion of the income is not considered as income. So you get tax benefits also. So for example, somebody is, let's say, earning 12 lakhs. 2 lakhs is being contributed into NPS, then immediately that person's income will be treated as only 10, not as 12. So irrespective of whether the company is doing it now or not, but as individuals, you can open. And whenever you have those surplus amounts which you feel you need to build a corpus, you deposit into that. And I think NPS accounts also can be opened online these days because Aadhaar verification online helps you open NPS accounts.
Hi, Arunachalam,
Yeah.
Priyanka here. Yeah, regarding MPS, as you said, like we can open it individually, but the problem is that only if the employer opens it, we get the tax benefit. When we open
That's
it
okay.
personally, yeah.
See, now whether your intention is to save tax or whether your intention is to build a corpus. That's why I very clearly said corpus. So whether someone is supporting you or not, if you have that as an aim to build a corpus, you go ahead, do it. In the meantime, company registers with NPS, then rather than you contributing, you tell the company to deduct and pay the same amount, you start getting your tax exemption. That's okay.
Just to add on, Priyanka, so even if you contribute individually, If you're opting for old regime, you can assume 50,000 in the ATC for the NPS, which is contributed individually. So the NPS, which is contributed by the employer, is applicable only for new tax regime.
Correct. So we actually, most of us are mostly getting into new tax regime because that's the reason. I know old it is still applicable, but for over new regime it is not applicable. Like if only if the employer does it, we get the tax benefit. So
Yes.
basically, most of us are enrolled in new tax regime. So that's something important for us to have it to employer.
See, the way you need to see is NPS contribution, if you do individually, it is not considered as a reduction from, I think it is 80 TT something is there from your salaries. Because as an individual, I'm saving it. But let's say in the month of January, Venzo opens or signs up with NPS authorities, and then they start deducting from the salary and remitting. And it is not a mandatory deduction. No? There are so many companies I can tell you where I was also working. We have internal portals where you could go change your contribution month on month. There is a defined date by which you can just go change the amount. So it is not maximum is 14%, but let's say the 14% comes to 10,000 rupees. But 1 month you want some extra money, you can just go change it to 8,000. So the company will only deduct 8,000 from your salary and pay to the NPS authorities. Next month, you again go back and change it to 14,000. It will remain 14,000. So that kind of flexibility is there. But if you're doing it on your own, it will not come down from your income. But if the company is doing for you, it will directly reduce from their income. That's all. But it can't be on a retrospective basis. So see, these are some of the characteristics: recurring and fixed deposits. It's a safe mode, fixed and stable returns. It is highly liquid. For example, within a day or two, you can get your money back if you are in need. Debentures and bonds are relatively safe. The word relative is very, very important. Relatively fixed returns, because some of the bonds and some of the debentures are also floating rate bonds. I don't know how many of you have seen it. So there is the floating rates as well in that. So that's why there is also a liquidity option. These debentures and bonds are listed in the market, but you should know, just because it is listed, it does not mean it is liquid. I have a bond and I want to sell. I need to have a buyer for it. Otherwise, every day I keep putting an order in the market. And if there is no one willing to buy that bond, then it's a problem for me. Though there is an option for liquidity, but there are no buyers. So that can happen in shares as well. I have not included stocks anywhere here now, but it will come subsequently. PF, PPF, SSY, NPS, everything is in the same bucket. They're very safe. They give you a stable returns and long term. I have not used the word fixed. Can you tell me why?
Because the government yearly once they used to change the interest rate.
It used to be, now quarterly.
Yes, correct.
So that is why if you look at recurring and fixed deposit, the day you put the deposit, whatever is the rate agreed by the bank, they will pay it for 5 years, 3 years, 2 years, whatever is the term. Whereas in PF, PPF, SSI, PF annually they'll reset the rates. PPF, SSY, they will always reset quarterly, but mostly the changes will happen once in a year. But they have that flexibility. The government has kept the flexibility to change it. That's why the word fixed is not here. Okay. Next is coming to creating wealth. So creating wealth is nothing but your corpus, next stage in life, moving into the next level of your economic independence. In this, there is something called unit-linked insurance plans. So in every place we are having insurances. I will tell you why I have it as well. So unit-linked insurance plan, gold, mutual funds and stocks, real estate. It can be in the same order. Creation of wealth can be in this order. So that's why I have put it in. What do you want? Have you ever heard of unit-linked insurance plans? But now it is not very popular in the market. 20 years back, it was really popular. Many people lost their money in this.
prior?
No, I haven't heard about this.
None of you have heard unit-linked insurance plan, then it is good.
Yeah, I in fact, I invested and as you said, I lost. I mean, the return was not good.
Sir, I'm sure whatever I'm telling the things you would have experienced it, but the younger lot.
Yeah,
If you've
yeah.
not heard it, it is better you don't hear it, because unit-linked insurance plans are a combination of two products where it is insurance and your investments. You have to be very clear whether you are putting this money to cover your risk or you're putting this money to multiply it. If you want to multiply, then go for a pure multiplying product. If your intention is to avoid risk so that your family does not suffer without you, then you stick to the pure insurance plan, which is coming subsequently in protection. So if anybody comes and talks to you about unit-linked insurance plan, you just tell them politely, no, sir or madam, I'm not interested in unit-linked insurance plans. I have other products in which I'm investing. Then comes gold. People in South India or India especially, we all invest in gold. Last year, gold is doubled, so that is a good one. But otherwise, mostly gold is a risk-free investment because the returns from gold always will oscillate between 1 or 2% more than inflation. That's all. It will not give you multiplying returns like how it has done last year. But last year is one of the scenario. It might not happen. But we all know we need to have some amount of gold if we have daughters to marry off, and that's a sentimental value. Otherwise, you can avoid gold as well. But gold is more risk-free investment. You will not lose value in it. But today, when you invest in gold, you never know. You might lose value because it's run up so much. Then comes mutual funds and stocks. So this is a little more riskier product, but it will give you more returns. In mutual funds, you don't invest in stocks, whereas you invest in the units of a financial institution like any of the mutual fund managers. Like how for NPS we had so many fund managers, mutual fund companies also will have fund managers. You choose one of them. You like ICICI, you choose them. Someone likes Franklin, they can choose them. Someone likes Nippon, they can choose them. So you invest the money, and that company will in turn invest in stocks or in debt or in gold or whatever is the asset class chosen by you. So, and then whatever is the returns, that will be the increase in value of your units or the dividend that they pay you back. Dividends from mutual funds are no more attractive because of the taxation. What I see is most of the people now invest to create wealth. If you want to create corpus, it is better to leave it in the regular funds. So stocks is a very, very risky game. You need to know which companies you're investing in. The chances of capital getting eroded is very high. But if you are good at, you know the company, you can invest. For example, tomorrow Venzo gets listed. Every day we are walking across Perumbakam. We see the board, the company. There are hundreds of people going to work, and you feel okay. This company is going to stay for 5, 7, 10 years. You can go and invest. Other, if you don't know the company, better not to invest. Go through mutual funds, but everything has a risk. I will tell you how. I have another slide to show. Then last is real estate. Real estate is when you have enough money to buy, because you need to save a lot to have that capital, and you need to invest that capital in real estate. So real estate again is very high risk because the chances of fraud, somebody occupying your land, all that is there. But if you overcome that, the returns are phenomenal. But I don't know whether the returns are going to be phenomenal now, because across India, the real estate has ballooned over the last 5 years. So we don't know. But it is a high risk, high reward kind of product as well to create wealth. So unit linked insurance, dual benefits, insurance and wealth. It's market linked returns only on wealth portion. See, there were a lot of regulations brought in to streamline. Earlier, unit-linked insurance did not have this bifurcation as well. Everybody thought I'm insured for 5 lakhs. Like I gave the previous example, I took the unit-linked insurance policy of 5 lakhs. I paid 20,000. I did not wake up the next day. My family got only 20,000 or 15,000 because they said insurance also progressively will increase. But now all that is gone. Government has said, IRDA has clearly said, out of the 20,000, you allocate 5,000 towards insurance, 15,000 towards investment. So these kind of things were all brought in at a later point in time. In spite of that, it's not an attractive product, according to me. Gold is a safe haven asset, hedge against inflation. It's highly liquid, but it might not create an asset for you. Mutual funds, professionally managed, market linked, and it is very liquid as well because you surrender your units within 2 days, they will have to make payment to you. But have you heard about mutual funds not making payments? That is also there. So none of these products are not 100% safe. So there have been instances where there were debt funds in India which did not pay the unit holders because at the end of the day they are investing somewhere, and that asset should also be encashable. Otherwise, you might lose. But the chances of that is less. But still, you should know as an informed investor, you should know chances of me not getting the money are also there in these. So stocks are highly risky and volatile. Capital appreciation is very high. Similarly, capital loss. It is very liquid. Again, that liquid is subjective. I put in the shares. Nobody in the market is willing to buy. Then the liquidity is questionable. So we can only say there is a platform to make it liquid. That's all. Real estate, domestic. Domestic, when I say it is houses for rent or houses for living by yourself. They are very high cost. You can do a finance leverage, meaning you take a loan and you create your asset. I take a loan for 10%, construct my house, but the value of the land and house might be like 12, 15% every year on year. So I pay 10% interest to the bank. I'm still gaining 2, 3%. That's the asset I'm creating over 5, 10-year period. It is very low in liquidity because you put a house on sale, you put a land on sale, it might take 6 months to 1 year to encash. Real estate commercial, like you're constructing shops or other office space, those kind of things. It is again high cost, but you get regular rental income. Again, it is low liquidity. Then protection. The protection is nothing but the standard ratio everybody prescribes is about you need to have 6 months salary in a liquid form. And after that is when you need to invest in assets for creating the corpus and all those things. Come what may, 6 months salary you should always have. But is that possible? For a few of us, it is possible. For a few, it is not possible. But this is general guideline. It's not a rule, so it's okay. Because as we said, if you are a first generation person, to save that 6 months salary and then start investing is not possible. But the usual financial rule is you have 6 months salary in a liquid form. It can be in a fixed deposit. It can be in recurring deposit. It's okay. But if you keep it, that is fine. So insurance fund and emergency fund. We've seen emergency fund is one. Insurance are of two types. One is health insurance. One is life insurance. We are all fortunate to work in a company. The company has health insurance. Whether the company's insurance is sufficient or not, you are the best judge. You need to see whether that is enough, then it is okay. Otherwise, better to take health insurance. If you take health insurance at a younger age, premium is lesser. Same is the case with life insurance. So life insurance is for if you are not there, your family should not suffer. That should be your motive to get into life insurance. Not to earn income, not to earn or not to create corpus. Life insurance is simply, if I am not there, my family should not suffer. That should be your motto. For that, you need to take life insurance. And I was telling you, when this life insurance will come into the second bucket and the investment will go to third is, for example, many of you are young, I've crossed this, but still, you are all saving some amount of money to create that initial deposit to buy a house or to buy the land so that you construct your dream home. You usually pay 20%, 30% of the value, and the rest is loan. So we'll take a hypothetical example of 1 crore is the asset value and 30 lakhs you've saved. You are, let's say, 30 years old, and 30 lakhs you give it to the seller, and 70 lakhs you take a loan. On that day, when you are signing on the papers of the loan application, you also need to sign your proposal form of life insurance for at least that same 70 lakh rupees. Whatever is your loan value, you need to have your insurance. I did that in my life. I know 90% of Indians don't do it, but you need to. That's the discipline we need to have. That is because today's world is unpredictable. I might be healthy, paying the EMIs for 1 year. Suddenly something happens on the road, something happened while I was traveling. Then 68 lakh rupees needs to be paid by our family. At that time, this insurance would cover that. The asset will remain with our family. Otherwise, the 30 lakhs is already gone. The asset will also be taken by the financier. So, in such circumstances, your insurance fund will come one step above your investments. I hope you understood when life insurance moves up and when you need to compulsorily have a life insurance. And the third one, property insurance. When you have an individual house you construct, it's always better to take property insurance as well, because you never know when you're submerged in water. And it will also cover some of your electronic instrument. But what I've heard from my friends is most of the times the insurance companies have never paid them. So all the electronic items gone are gone. So that's another part of it. So now we all said we have to be an informed investor when we go back from this session, right? This is a very, very important one. Irrespective of you being an informed investor, there are chances that we might not make the kind of money we would make. For example, let's say judiciously every month 10,000 rupees I was saving starting from 1st of January. I was ending on everything is in 2020, but you just see the difference. One is the 20th of Jan, another one is 23rd of March, 31st of December. Why 2020 is significant, friends? Can any one of you tell?
Due to COVID.
Yeah, that is the uncertainty we all faced. 20th of Jan was prior to COVID. 23rd of March is just when lockdown was getting removed, or the first lockdown was over. And 31st December is just to take the end of the year. You just see, we made the investment 10,000 every month. Had you withdrawn on 20th of January, you would have got 18 lakh rupees. But on 23rd March, when the first lockdown was completed, if you withdrew, you just got 11 lakh 36,000, a meager 0.5% as return. But if you waited till 31st December and you withdrew, it was 22 lakhs. So this is one unfortunate incident that happened, and I've taken that as an example. But these kind of things can also happen in various other ways. So for that, I've given you two other tables. If you notice, the first one is at peak. You ended the SIP at the peak. You invested 14 lakhs. You got back 28 lakhs. Then nobody knows what is the peak. So after 1 year of peak, the market was going down. You felt the market will go down further. So after 1 year of the peak, you withdrew. So you got 23 lakhs. Sorry, 1 year before. And when it is 1 year after, you got 31 lakhs. It all depends when. So now the peak, rather than peak, we can take it. My daughter needs to go to college. The college does not wait for your market peak. The college does not wait for the bottom. I have to withdraw because I have to pay my college fees. So I might have got 28 lakhs, but since my daughter was supposed to go to college this year, I withdrew everything. I just got 23 lakhs. So does that mean I lost money? No. I have withdrawn for my need and for my daughter's future. So that is where. So you cannot imagine that you will always make money. You have to be disciplined. There is some amount of luck, some amount of timing. The return also varies significantly from when you enter, when you exit. We can't, as individuals, time, but we have to be disciplined, and there is an external force which might support you. If you have been honest, the external force will also support you. If you were dishonest, probably the external force may not. So that's what I actually want to tell you. So I hope you're all going back as informed investors. Nobody can be intelligent, nobody can be successful because of these tables. You can see. And we've not taken very high risk things. I've just put in your Nifty index itself. So when you start, when you end, everything matters. Any other questions, you can write an email or drop in a note. I will respond if I know.
Currently பாத்தீங்கன்னா சார் silver is the new goldங்கறாங்க and gold is kind of
As I said,
saturated.
so those things we should talk separately. This was more to explain the different asset classes. Gold and silver are not equal. I can give you examples from my real life itself. Gold is gold, silver is silver. There's no comparison between. Silver may have run up, but then there are chances that it can also fall 90%. But gold will never fall 90%.
Okay, I also have one question that like, do you suggest like people, because I'm hearing a lot of hype of SIPs. So is it a good source of investment for people who haven't started yet to get into SIP?
See, it again goes back to your fixed deposit and recurring deposit. The same logic needs to be extended here. You have money at once, you want to invest, go ahead and invest. You are dependent on your salary to invest, then SIP. Or you say, I'm not a very disciplined person. 1 month I have 10,000, 1 month I have 8,000, 1 month I have 12,000. Then month on month, you just invest. It's not SIP. SIP is just a term, that's all. How you want to invest is up to you. I hope this session was useful. A little bit information about various products that are available.
Thank you, Arunachalam, for the vivid explanation
thanks a
about
lot.
personal finance.
Thank you.